Welcome back to the Deep Dive. This morning, our mandate is all about institutional clarity.
That's right.
You've given us the weekend financial briefing, and this is the exact framework major asset managers are using to position for the week of December 2nd, 2025.
Yeah.
We're not interested in the headlines, the superficial narrative. We are here to really analyze the structural integrity of the markets right now as of this weekend.
That's absolutely the mission today. We have to cut through all the sentiment, all the noise, and look at the cold, hard metrics that truly define strategic risk and, opportunity.
Okay.
So we're examining the three core mechanics that really dictate where the smart money is moving. That's liquidity, volatility, and correlation.
The big three.
The big three. And sentiment might, it might appear to be resting at a comfortable neutral. But beneath that calm surface, the gears of the market are grinding in ways that, frankly, fundamentally challenge traditional investment beliefs.
So our task is pretty clear. We need to dissect the price action from last week, the one that took us into the holiday. Was that rally actually built on conviction?
Or was it just thin air?
Exactly. Then we have to analyze the VIX, the CBOE Volatility Index. I mean, a 40% collapse is shocking.
It's a huge move.
But it's still sitting in a deeply critical position. And then, maybe the most important piece of this whole puzzle, we need to understand in detail why the current environment, with all these correlation breakdowns, is forcing institutional investors to completely rework or even discard their foundational models.
Especially the sacred 60-40 structure.
It's a 60-40. So we're looking for the fault lines.
The convergence points, the non-obvious risks. Let's start by grounding ourselves in what just happened. Let's look at the technical map from last week.
All right, let's start with that immediate action. The S&P 500 closed out the week looking good, especially for a holiday-shortened week here in the U.S.
It did.
It felt strong, but was that upward thrust, was it convincing enough to really signal a structural shift? Or was it just, a technical relief rally?
The word I would probably use is constructive,
Yeah.
but heavily qualified.
Yeah.
We saw the S&P 500 register some pretty broad weekly gains, which is, undeniable strength on the surface.
Right. 4 straight days in the green.
Exactly. Crucially, the index closed higher for 4 consecutive days leading into the weekend. Let's just run through them. Monday was up 1.6%.
A strong start.
A very strong start. Tuesday added another 0.91%. Wednesday, just before the holiday, gained 0.69%.
And even Friday.
And even the short Friday session managed to tack on another 0.5%, 0.54%. That consistency, it suggests there's some underlying demand there, or maybe some aggressive short covering.
Consistency does matter, especially when you're trying to recover lost ground. But momentum by itself doesn't break major ceilings. Where did all that buying power actually put the index, technically speaking?
It put the index at the absolute moment of truth. I mean, this is it. The key technical achievement for the bulls was rallying back to and slightly exceeding the declining 20-day moving average.
That was the first hurdle. Around 6,750.
That was the first hurdle, right. But the move stalled precisely where it shouldn't have if true conviction was really there.
Okay, so where do we close?
The S&P 500 closed at 6,849.09. That is, for all intents and purposes, hitting its head directly on major established resistance at 6,850.
And just a stone's throw from the all-time high.
Just shy of the all-time high at 6,900. It's a textbook resistance test.
So, okay, on one hand, we successfully defended some key support levels earlier in the week, maybe around the 6,700 mark.
We did.
And we successfully broke that short-term declining average. That screams short-term bullish break of structure. So why aren't we celebrating this?
Because a technical break of structure in the short term does not equate to a long-term structural shift.
Especially on low volume.
Especially when volume is considered. Yes, we are leaning against the ceiling of a much, much broader trading range. For institutional capital to truly deploy, to commit to a sustained long thesis, we need confirmation.
And confirmation means what?
It means a decisive high conviction break. A move above 6,900 is absolutely required to confirm a long-term structural breakout.
And the other side of that coin?
Conversely, a rejection right here and a break below, say, 6,500, would confirm a larger, longer bearish structure is taking hold.
So we're trapped.
Right now, we are trapped in the purgatory of range-bound trading, and we have absolutely zero margin for error hitting this 6,850 to 6,900 zone.
This brings us squarely to the conviction question, volume. It's Thanksgiving week in the U.S., so of course we expect thinner volumes. But how did that thinning volume impact the quality of this rally right into major resistance? Because, pushing a heavy door on low volume is usually a recipe for a quick reversal.
The volume story is the definitive constraint on any bullish enthusiasm right now. Trading volume for the S&P 500 on Wednesday, November 26th, that was the last full day of trading. It was markedly lower than the last 20-session average.
So the big players weren't really participating.
That tells you the move up was not uniformly supported by broad market participation. It just wasn't.
But we can't just ignore Monday's action, right? That was pretty substantial.
Exactly. The story is mixed. It's not universally weak. Earlier in the week, particularly on Monday, November 24th, the SPY ETF saw some significant volume bursts. It recorded a substantial $7.8 billion in transactions.
So where was that money going?
And when you look inside that flow, the buying pressure was highly concentrated in very specific areas: technology and consumer discretionary.
So the usual suspect.
The usual suspects. That suggests the large funds, the sector specialists, they were active early. They were betting on holiday spending figures and that secular growth narrative.
So basically, it was a growth-driven early week burst that lifted us up to resistance, and then the broader market, the institutional follow-through, it vanished by midweek.
Precisely. The growth sectors did all the heavy lifting, but the tail end of the week saw institutional liquidity just drain away.
And the options market.
Look at the options market volume on Friday, November 28th. SPX options volume came in at 1.887 million contracts.
Which sounds like a lot, but what's the context?
The context is that's a shocking 30.43% decrease compared to the volume we recorded on the equivalent Friday a year ago.
30%.
A 30% gap isn't just a holiday slowdown. It's reduced activity and, critically, a reduced willingness by institutions to take on new risk heading into the weekend.
Okay, so that 30% decline in options volume, combined with the thinning cash volume on Wednesday, that gives us our key takeaway for this section. The rally to 6,849, it lacked conviction.
It did.
Yeah.
And this is the critical analysis point for the week ahead. When price rallies into major established resistance like 6,850 to 6,900 on thinning volume, that upward action is inherently vulnerable.
It's weak.
It lacks the institutional muscle required for a decisive, sustained structural breakout. If you're running a large book, you cannot confidently follow this rally unless you see a high-volume breakout above 6,900.
So without that volume confirmation.
Without that volume confirmation, the current rally looks like a perfect liquidity zone for overhead supply of the sellers to liquidate positions, which is a significant factor in our bear case scenario planning.
In other words, the market gave us a beautiful technical entry into the selling zone, not a buying zone.
That's the institutional interpretation, yes. High reward potential if 6,900 breaks, but currently a low probability given the lack of confirmation volume.
Let's pivot from price action to market anxiety. Let's focus now on the CBOE Volatility Index, the VIX. This was, arguably the loudest signal of the week.
It was huge.
A massive 40% collapse in just 5 trading days. Wait, a 40% drop in the VIX. That sounds like the market just collectively shrugged off every single fear. Why are we calling this a fragile calm?
It's fragile because the speed of the compression was historic. And just as importantly, it brought the VIX down to a highly contested technical support level.
Okay, so walk us through the numbers.
The VIX plummeted from a peak near 29 on November 20th, and it closed Friday at 17.19. A 40% compression like that signals that the immediate panic, the tail risk that caused that spike, has, for now, evaporated.
This is what retail traders love to see, right? The rapid return to complacency.
It is. And when that VIX spike hit 29, it wasn't just panic. It was a very specific technical signal for the systematic funds, wasn't it?
Absolutely. The VIX spike peak on November 20th triggered a technical buy signal for equities on the 21st.
Right.
And historical analysis suggests that a signal like that typically supports near-term bullish action for approximately 22 trading days. So that pattern supports what we saw in the S&P rally.
It supports the idea that the immediate aftermath should favor risk assets, which is exactly what we saw.
Yeah.
But that signal has a lifespan, and we are now moving past the point of its maximum technical advantage.
Okay, let's talk about the structure of volatility itself, the VIX term structure. When volatility cools off, we expect the curve to slope upwards contango.
Correct.
Explain the deep significance of the weighted VIX futures premium improving so drastically. Specifically, let's use the Vol Futu metric.
Right, so contango is just foundational to understanding market stress. It simply means the futures contracts are trading at a premium to the spot VIX. This is the normal, calmer, low-stress regime where volatility is expected to regress to the mean over time.
And before the spike, we were in backwardation?
We were likely flirting with it, or in it, yes. which means the market expected immediate volatility to be higher than future volatility, a classic sign of acute stress or panic.
So the shift back to contango is the market saying the fire is out and things look normal down the road.
Exactly. And the metric that captures this institutional expectation is the weighted VIX futures premium, known internally as Volo-Futa.
How does that work?
This calculation takes the price difference between the front month and the back months of VIX futures, and it weights them. The fact that Volo-Futa improves so dramatically, moving from a stressed reading of negative 3.00 to a strongly bullish positive 1.73, that is a powerful institutional signal.
So it's a big green light.
It indicates a wholesale normalization of short-term risk expectations across the entire volatility curve. This movement is typically a very, very reliable bullish indicator for the equity market.
Okay, so Volo-Futa is screaming calm. The VIX has fallen 40%. Why the hesitation? Why do institutions call this fragile, and why are they maintaining all this downside protection?
The hesitation is captured in the institutional hedge itself. It's hidden in the options pricing.
Okay.
Despite the statistical return to calm and the strongly positive Volo-Futa, investors are maintaining significant and expensive downside protection. We can see that out-of-the-money put options, the insurance against sharp catastrophic sell-offs, are trading richer or more expensively than comparable upside calls.
That sounds like cognitive dissonance. The VIX is saying risk is low, but the actions of the big players are saying, we still believe in black swans.
It is dissonance, but it's a strategic dissonance. The immediate panic has subsided, yes, but the institutional base remains fundamentally wary of underlying structural downside risks.
They're willing to overpay for insurance.
They're willing to pay an elevated premium for insurance against a low probability, high impact event. This indicates that while the day-to-day trading is calmer, the strategic outlook remains highly defensive. They've bought the dip, but they've also paid for the fire extinguisher to be right there on standby.
This brings us to the convergence point, which is the immediate trade setup for this coming week, starting December 2nd. The VIX and the S&P 500 are simultaneously hitting critical lines. Unpack that for us.
This is the highest probability short-term inflection point we have. We have to look at where the VIX settled at 17.19. It is now resting right on a critical rising trendline support.
A line that's held all year.
A line that is held consistently throughout 2025, sitting at approximately 16.60. At the exact same moment, the S&P 500 is hitting its major overhead resistance between 6,850 and 6,900.
So if the S&P 500 fails to break out above 6,900, and we remember that lack of volume conviction, then this whole rally is threatened.
Absolutely. A failure to break 6,900 on high volume would quickly validate a larger bearish structure. And critically, that failure would likely send the VIX bouncing hard off that long-term 16.6-year support level.
And if VIX bounces?
If the VIX bounces, volatility returns, and the institutions who bought those rich out-of-the-money puts are suddenly validated.
And the flip side?
Conversely, if the S&P 500 somehow muscles its way past 6,900, the VIX would likely crash through 16.60, confirming the market's complete confidence in starting a new leg up.
It is a binary decision point sitting right in front of us. If you're positioned neutrally, you have to be ready to execute an instantaneous shift based on which of those two levels breaks first.
Precision and readiness are everything here. This convergence means both the risk-on and the strategic risk-off trade setups are simultaneously at their inflection points. That's going to make the next few sessions incredibly volatile for anyone who lacks a clear action plan.
Let's move deeper into the technical plumbing of the system. Liquidity. If the VIX represents market psychology, liquidity represents the market's physical ability to function, to absorb large institutional trades without distortion.
Right.
Where are the current vulnerabilities, and how is this structural tightening affecting efficiency?
Liquidity is not just a vulnerability. It's a structural time bomb.
Yeah.
And that's primarily due to the persistent effects of quantitative tightening, or QT.
The Fed draining the system.
Central banks are structurally draining reserves from the system. This translates directly into moderately tighter funding conditions in money markets, resulting in higher overnight rates and, generally, increased rate volatility. Dealers and banks simply have less capacity to intermediate large flows.
And we saw this fragility play out in real time just last week, even during a holiday-shortened period. Can you elaborate on the patchy trade that was seen in Treasuries?
Yes, the localized strain points are very telling. On Friday, November 28th, we saw unusually wide spreads between bid and ask levels in U.S. Treasury yields. This signaled what we call patchy trade.
Meaning?
periods where buyers and sellers were difficult to match, causing price gaps. This was especially true during the thin holiday hours and amid some reported technical issues at the CME.
And that's not supposed to happen in treasuries.
In a deep, healthy market, treasuries should never be patchy. When the bedrock of global finance, the treasury market, shows signs of illiquidity, it immediately raises red flags for institutional desks about systemic stability.
How does the rise of new, highly leveraged trading instruments factor into this? We're talking about fragmentation risk, particularly with things like perpetual contracts or PERPs.
Fragmentation is a major headache. Institutions are tracking the rise of these contracts, particularly in the crypto-adjacent and high-leveraged derivative space.
What's the risk there?
Data from the last year shows that perpetual contracts, especially those with high leverage ratios, often exhibit much wider bid-ask spreads and dramatically lower liquidity during off-peak trading hours.
So it creates asymmetries?
Clear market asymmetries. If a major fund needs to unwind a large position or hedge using these instruments when, say, APAC markets are active but the U.S. is quiet, the cost to exit can be punitive. That lack of predictable deep liquidity creates systemic fragility during global trading hours.
We talked about dealer capacity earlier, but let's just connect that one more time to the structural problem of Treasury supply.
It's a vicious cycle.
Yeah.
Persistent structural deficits mean the Treasury has to issue massive volumes of new debt.
Right.
Dealers, who are constrained by post-crisis regulations and the effects of QT limiting their balance sheet capacity, they have a limited ability to absorb that risk.
So there's more supply than there is capacity to handle it.
Exactly. This limited capacity contributes to significant price pressure effects and potential volatility spikes around major treasury auctions. The market needs to absorb a supply tsunami, but the dealers are, wearing wetsuits instead of full armor.
Let's pivot now to the correlation breakdowns. This is the existential challenge for passive allocation models. The mission statement highlighted this as a key driver for rethinking entire portfolios. What is the overarching trend we're seeing in cross-asset correlations?
We're seeing a structural, sharp fall in return correlations across major asset classes throughout 2025. This is critical. The median pairwise correlation across global ETF proxies for daily returns is down significantly to 0.52.
From a peak of what?
Compared to a recent peak of 0.66.
Wait, now isn't falling correlation generally considered a good thing?
It is for active managers.
Yeah.
When correlations are high, when everything moves together like they did during peak pandemic stress or liquidity shocks, alpha generation is almost impossible. You can't diversify away risk.
There's nowhere to hide.
Nowhere to hide. When correlations fall, it enhances the climate for global asset allocation and, crucially, for skilled managers to generate alpha, or excess returns, because their stock picking and their timing can actually shine.
But the type of correlation breakdown matters.
It matters greatly.
So where is the most reliable low correlation found right now? Where is the true diversification?
It is between equities and commodities. Research, notably from UBS, highlights this relationship. We're talking a 5-year rolling average correlation of 0.18 to 0.28.
That's very low.
Very low. This makes commodities an inherently effective diversification tool. And given that equity valuations remain elevated and the macro environment is ripe for supply shocks.
Geopolitical risk.
Geopolitical risk, exactly. A tactical allocation to inflation-sensitive commodities is highly prudent right now. It's far beyond just using them as an inflation hedge. They are a diversification hedge.
Okay, now let's tackle the central thesis of this challenge, the 60-40 problem. The traditional portfolio relies entirely on that negative correlation between equities and bonds. Why has that relationship been so profoundly challenged this year? And why is this so dangerous for the average diversified investor?
The 60-40 model worked flawlessly for, 40 years? Because it operated in a disinflationary low-rate environment.
Right.
Bonds acted as the insurance policy. When the economy slowed, equities fell, but interest rates also fell, which caused bond prices to rise, thereby offsetting the equity losses.
The classic seesaw.
The classic seesaw. That entire mechanism is now structurally compromised.
How does that mechanism actually fail?
The negative correlation flips, and sometimes violently, to positive when two structural factors are present: high interest rate volatility and, most crucially, inflation that consistently exceeds the central bank's target, say persistently above 3%.
Okay, let's break down the mechanism of that failure. If inflation is sticky above 3%, why do both bonds and stocks suffer at the same time?
It all comes down to the discount rate. High, sticky inflation forces the central bank, the Fed, to maintain a structurally hawkish posture or keep real rates high for longer.
The higher for longer narrative.
The higher for longer narrative. Now, start with the impact on bonds.
Yeah.
High nominal and real interest rates negatively impact fixed income. New debt is issued at high yields, which makes all your existing bonds less valuable, driving their prices down. So bonds get hammered. The insurance policy fails.
And stocks.
Equities are valued based on the discounted present value of their future cash flows. The higher the prevailing interest rate environment, the discount rate, the less valuable those far-off future earnings are today.
They get discounted more heavily.
Therefore, the high discount rate driven by sticky inflation and a hawkish Fed simultaneously lowers equity valuations. The common enemy inflation and the subsequent high rates strikes both asset classes at the same time.
Wow.
This transition to a positive correlation regime significantly increases overall portfolio volatility, and it annihilates the benefits of traditional diversification.
So the 60-40 investor who thought they were diversified actually has a portfolio where, in the face of inflation, 100% of their capital is exposed to the same structural threat.
That's the danger.
That demands a dynamic, ongoing reevaluation of the entire allocation framework, doesn't it?
It demands agility. Yes, static allocation based on historical correlations is now potentially structurally dangerous. Institutions are moving away from relying on fixed income as the primary hedge. They're looking towards sophisticated option strategies, managed futures, and real assets to take over that hedging function.
Let's zoom out now to the macro forces shaping the strategic moves of smart money. We have to start with the Federal Reserve and that persistent question of when or if the rate cut cycle will proceed as everyone expects.
Right.
What is the current institutional consensus on the FOMC outlook?
The prevailing expectation, which, forms the baseline for risk asset pricing, is for continued measured pace of rate cuts into 2026.
And what's the target?
The market is pricing in a federal funds rate, settling around 3% by December 2026, down from the current 3.75% to 4.00% range.
Right.
But this consensus is built on sand. It is highly, highly data dependent.
So what data points are currently holding the Fed hostage and keeping institutional desks glued to their screens?
The primary focus remains the dual mandate, specifically the 2% annual PCE inflation target and the resilience of the labor market.
And inflation is still the problem.
While headline inflation has moderated, core goods prices remain elevated. This persistence is partly due to the cumulative and lagged effects of tariffs and trade restrictions, the peak impact of which is still expected to land around year-end. If goods inflation stays sticky, the Fed simply cannot afford to ease aggressively.
And Chair Powell signaling it continues to lean hawkish even after the recent modest rate cut. Why is he maintaining that cautious tone?
That hawkish tilt signals caution and commitment to the inflation fight. It tells the market two things. First, cuts are data-dependent, not date-dependent. And second, the risk of prematurely declaring victory over inflation is higher than the risk of engineering a soft landing.
So what are the pros watching?
Smart money is closely watching the Summary of Economic Projections, the SEP, for any shift in the dot plot that might signal a lower long-term terminal rate or a sudden acceleration in the pace of normalization. A continued hawkish lean prevents institutions from getting aggressively extended on duration too soon.
Next, let's talk about the looming U.S. Treasury supply dynamic. This is a structural challenge, not cyclical. It's long-term. The sheer volume of debt is it's overwhelming the market.
It is overwhelming. We are projecting federal government debt to hit 100% of GDP next year.
100%.
Rising further to 122% by 2034. This supply tsunami is the single biggest headwind against lower long-term rates. It's the reason the term premium has risen so substantially.
Explain the term premium using an analogy so our listener can really grasp its significance.
Okay, think of the term premium as the risk rental fee for time. It's the extra yield, the extra compensation that investors demand to hold long-dated treasuries.
A fee for uncertainty.
It's compensating them specifically for the uncertainty of inflation and interest rates over that long duration. If you lend money to the government for 3 months, that risk is low. If you lend it for 30 years, you demand a significant rental fee to cover the uncertainty of future inflation eroding your returns and the chance the Fed might unexpectedly hike rates.
And we saw tangible proof of this rising term premium translating into weaker demand just recently.
Precisely. We saw a tangible dip in demand at recent 7-year note auctions, and that was indicated by a lower bid-to-cover ratio. The market is telling the Treasury, we are not as hungry for this debt as you need us to be, and we demand higher compensation for taking on this duration risk.
And what's the immediate impact of this increased Treasury supply on the broader market beyond just the bond market?
It's broadly deflationary for risk assets and inflationary for volatility.
How so?
Increased Treasury supply drives up the cost of borrowing and typically leads to an upward shift in the yield curve, especially at the longer end. This translates into several negative factors: declining stock prices, rising corporate risk premiums because credit spreads have to widen, and generally increased market volatility because funding costs are less predictable.
It raises the cost of capital everywhere.
It fundamentally raises the cost of capital across the entire economic structure.
We also have the specific leverage mechanics of the basis trade impacting the supply picture. What are relative value participants doing, and why is this activity, though it's benign most of the time, a crucial liquidity consideration?
The basis trade is highly technical but structurally important. It involves relative value participants, typically hedge funds, simultaneously selling Treasury futures and buying the underlying cheaper cash Treasuries.
Exploiting tiny price differences.
Exactly. They exploit tiny pricing differentials, acting as market arbitrageurs. But crucially, they're creating a huge volume of Treasury duration exposure. Essentially, leveraged bets on the direction of rates that sits off balance sheet.
So they're increasing duration risk in a leveraged way, but it's not transparent on traditional bank balance sheets.
Correct. And while they provide liquidity and keep prices rational by exploiting these mispricings, the sheer volume and leverage used are what the Fed and institutions monitor so closely. This activity adds substantial hidden duration to the system.
And if rates move sharply against them?
If rates move sharply against their positions, margin calls could force a sudden, simultaneous unwinding of these leveraged positions, which could stress funding markets. And we've seen this movie before, though on smaller scales. It's a key liquidity consideration because it contributes to volatility and potential stress points in the overnight funding markets if a shock occurs.
Finally, let's just acknowledge the fat tail risks. Institutional models are not just looking at economic cycles anymore. They are explicitly factoring in geopolitical risks that defy traditional probability distributions. What are the key areas of concern?
The key concerns are permanently elevated. We're talking ongoing conflicts in contested regions, persistent trade tensions, the increasing sophistication of cyber warfare, and of course the underlying volatility of U.S.-China relations, especially concerning trade and technology.
Why do these fat tail events warrant explicit modeling beyond just standard risk management?
Because the impact is disproportionately large. It's persistent, and it's nonlinear. Geopolitical shocks are statistically associated with lower forward equity returns and higher forecast volatilities.
So they're preparing for the worst.
Smart money isn't just saying, oh, there's risk. They are explicitly modeling scenarios where a severe shock, say, an energy supply disruption due to a conflict, can flip the entire market regime overnight. A large institution understands that a 1-in-100-year event, when it happens, is far more destructive than 100 1-in-50-year events. They are hedging the catastrophic, nonlinear scenarios.
Okay, let's synthesize this whole landscape. We have an environment defined by neutral surface sentiment but deep structural fragility.
Right.
We've got tight liquidity, a fragile calm and volatility with the VIX at a tipping point, and severely challenged correlation dynamics. If you're running billions, how are you positioned for the week starting December 2nd?
The posture is cautious. It's defensive, but highly opportunistic in very specific areas. They are prioritizing balance sheet quality and resilience over chasing marginal growth.
Let's start with the bond market posture. Are they aggressively buying duration yet, given the eventual expectation of Fed cuts into 2026?
No. They are maintaining a stance of defensive duration with tactical flexibility. They are not aggressively extended on duration because the persistent inflation threats and Powell's hawkish lean prevent that kind of commitment. The positioning is moderate duration. They are keeping their powder dry, ready for active duration management.
So they can move quickly.
To extend duration if clear disinflation signals emerge, or to rapidly shorten it if inflation proves stubbornly sticky due to tariff effects or a geopolitical shock.
And within fixed income, where is the capital preservation focus?
Quality, quality, quality. Amidst slowing growth signals and macro uncertainty, there is a strong emphasis on high-quality fixed income, investment-grade corporate bonds, and sovereign bonds.
A flight to safety.
It's a capital preservation mandate. They are highly selective in credit, looking at niche areas like senior loans and municipal bonds for yield where the risk is well managed. Crucially, there's increasing interest in unconstrained global credit strategies, allowing managers to exploit diverse, non-correlated opportunities internationally.
And inflation hedges.
And they are using TPS and real assets for the necessary inflation hedging that nominal bonds no longer provide reliably.
Okay, moving to equities. Given the S&P 500 is knocking on that resistance ceiling, is the general lean risk on or risk off?
The general lean is marginally risk-off. It's primarily favoring capital preservation through quality fixed income. Equity exposure is highly concentrated and opportunistic.
Meaning what, exactly?
They're ruthlessly prioritizing sectors with defensive characteristics. So companies with strong, clean balance sheets, clear, sustainable pricing power that can handle sticky inflation, and critically consistent free cash flow generation. The market is paying a premium for operational resilience.
And what about the explicit macro or geopolitical plays baked into the equity structure?
Yes, the models demand it. Due to continued geopolitical instability and the structural, decades-long push toward climate transition, we see specific targeted allocations. This includes energy and materials as a hedge against supply shocks and commodity-driven inflation, and also defense sectors due to persistent global conflict and the continued need for state-level spending. These are often viewed as durable sectors, regardless of the short-term economic cycle.
Let's move to the strategic playbook for this week, December 2nd through the 6th. We've got major data coming out, global PMIs, Eurozone CPI, and U.S. non-farm payrolls.
A big week for data.
We have 3 scenarios, each with a probability. Start with the bull case, the most optimistic path assigned a 35% probability.
The bull case is the classic Goldilocks scenario. Everything breaks perfectly. The drivers would be softer than expected inflation data, maybe a low Eurozone CPI flash estimate, combined with resilient but non-overheating growth.
So a moderate NFP with cooling wages.
Exactly. A moderate NFP print, but clear evidence of cooling wage growth.
Yeah.
The market would just breathe a collective sigh of relief.
If that materializes, what happens to our core structural metrics?
Confidence surges. The VIX trends decisively lower, crashing through that 16.6-year support line. And crucially, correlation turns firmly negative, meaning bonds and equities decouple and resume their traditional hedging roles. This would favor a broad risk-on rotation.
And the specific playbook for that 35% outcome.
Aggressively favor growth equities, particularly those in technology that benefit from lower discount rates, extend duration in fixed income, and consider tactical long positions in investment-grade credit as spreads tighten due to that increased confidence.
Next, the bear case, assigned a 25% probability. This is the scenario where the fragility breaks, and it breaks violently.
This is triggered by acute stagflationary signals, so sticky, persistent inflation combined with rapidly deteriorating growth data-poor PMIs or a sharp drop in NFP. Or it could be triggered by an external sudden liquidity shock or a geopolitical event.
How catastrophic is the structural reaction in that bear case?
The VIX spikes violently, potentially moving into backwardation on the front end of the curve, which signals acute immediate fear. The worst part is that the equity-bond correlation turns positive, maybe violently so.
So both go down together.
Meaning both asset classes suffer simultaneous deep declines, amplifying portfolio drawdowns dramatically.
The playbook here has to be aggressive de-risking and absolute preservation of capital.
Absolutely. The mandate is to aggressively de-risk. You dramatically increase cash holdings, lengthen allocations to safe havens like the US dollar, gold, high-quality ultra-short-term treasuries, and you immediately implement tactical long volatility strategies, buying VIX futures or deep out-of-the-money puts on equity indices to directly hedge that tail risk.
Finally, the most likely probability path assigned a 40% chance, the grinding market. This is the baseline where most institutional money is positioned, betting on continued ambiguity.
This scenario anticipates a continuation of mixed, ambiguous data. We get an NFP that is just moderate enough not to alarm the Fed, but inflation data remains sticky, perhaps due to those tariff effects we discussed.
And the central banks stay on the sidelines.
Crucially, central banks remain wait and see. They avoid strong forward guidance, leaving the market just guessing.
If we are grinding, what happens to the structural dynamics?
Liquidity remains moderately tight due to QT, creating minor localized stresses but no systemic shock. Volatility remains range-bound, likely in the 18 to 20 area, maintaining a contango slope, but potentially flatter. Minor spikes will occur, but they'll fade quickly.
And correlation.
Correlation remains highly variable. It'll oscillate between slightly negative and marginally positive, failing to firmly reestablish that reliable negative regime. This is the hardest market to manage.
So, if volatility is contained but unpredictable and correlation is unreliable, how do institutional managers navigate this grinding market?
You manage for complexity, not for directional bets. You maintain a balanced quality approach using a barbell strategy.
A barbell.
In equities, you overweight those sectors with consistent, reliable free cash flow and pricing power, the defensives. You allow tactical exposure to selective AI-related tech names only where the cash flow supports the valuation, seeking alpha there.
And the fixed income barbell.
It's a barbell for duration. You hold short-term, high-quality sovereign bonds for absolute preservation and liquidity at one end. At the other end, you maintain a readiness for tactical duration extension on significant data-driven dips, but you don't commit fully.
And the hedge.
And critically, because correlation is not providing protection, you must utilize structural long volatility positions, buying cheap, long-dated protective puts as the permanent replacement for the failed bond hedge.
Let's just synthesize the core conflict we've detailed today. The market is currently exhibiting a kind of surface complacency, that rapid VIX drop we saw, but it is underpinned by deep, persistent structural fragility.
This is driven by persistent inflation threats, a severely challenged equity-bond correlation dynamic, and structurally tight liquidity due to quantitative tightening and massive debt supply. The neutral sentiment the market is currently projecting is, in reality, nothing more than a fragile equilibrium.
So the overriding actionable takeaway for you, the listener, is the absolute necessity of agility. A static, set-it-and-forget-it asset allocation model is functionally dangerous in this environment. The structural breakdown of the 60-40 correlation means you can no longer rely on traditional fixed income to automatically save you when equities suffer a downturn.
It just doesn't work that way right now.
Therefore, active dynamic management of your volatility exposure and constant vigilance over correlation dynamics are absolutely paramount to successfully navigating what the institutions anticipate will be a prolonged grinding market ahead.
We noted earlier that high geopolitical risk is statistically associated with both higher forecast volatility and lower forward equity returns. We ask you to consider the ultimate worst-case scenario, the one that portfolio managers dread. What if a major geopolitical shock occurs? For example, an escalation that disrupts energy or shipping supply lines. That shock would simultaneously fuel inflation, forcing the Fed to maintain high rates or even hike further, while hammering global equities due to the uncertainty and margin compression.
This is the precise scenario where the equity-bond correlation flips violently and positively, leading to the worst possible outcome for traditionally diversified portfolios. This environment demands truly non-traditional hedging.
It does.
So the final question we leave you with is this. Beyond cash and gold, what are the specific non-traditional assets or strategies, perhaps managed futures, commodity trend following, or unconstrained global macro plays that offer true non-correlated diversification and protection in that high inflation, high geopolitical risk environment? That is the structural challenge for smart money in the coming year. Prepare your playbook accordingly.